We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is somebody that was responsible for bringing a lot of attention to silver through the Reddit Wall Street Bets subreddit, and has now posted an extraordinary amount of research and due diligence on what's happening with the silver squeeze. He's known as the Happy Hawaiian. How are you today?
I'm doing well. Glad to be here, Tom, for my audio debut. I don't know if my voice sounds like what people expect, but it is what it is. So you get to listen to this for the next 30 minutes or so.
Well, it's excellent to have you. And why don't you start by telling us a little bit about why you want to remain anonymous, A, and B, about how this whole story started to unfold really over the last 2 months here.
Yeah. So, I've always been interested in investing and finance, I would say macroeconomics generally. I'm kind of an information addict. I also like to do YOLO plays and a little bit risky in terms of getting involved in some of the Wall Street Bets, more exciting elements. So naturally, I was part of the GameStop squeeze. I was not one of the original people. The first leg up, I bought around 100. I sold around 300. Not a huge position or anything, but it was a lot of fun. And kind of in the middle of all of it, the same day that they shut down purchases of GameStop, there was a big controversy. A lot of people were posting about potential other short squeeze plays. Mm-hmm. And one of them I saw that was interesting to me, given my podcast listening habits, knowing that silver is very heavily shorted, was someone suggested a silver short squeeze. They didn't really have much detail on their post though. So I started writing just kind of stream of consciousness about the potential for a silver short squeeze. Both of our posts blew up. They got on zero hedge. I think the other media took it from there. There was a subsequent backlash against silver. There's a lot of Reddit politics that went on. I can say I'm not from a hedge fund or any kind of investing based firm in the vein of deep fucking value, DFV. I am not a cat. And unfortunately, I'm not actually Hawaiian. I have visited Hawaii. Shortly after doing so, I made a Reddit account and wished I was a Hawaiian. So a lot of people have speculated if I'm from Hawaii or not. Sadly, I am not from Hawaii. But because my silver post blew up and I am actually very interested in the silver squeeze now, I am playing it. I wanted to do a lot more research and have done a lot more research. And I think that shows if anyone has actually followed my posts, they're a lot more detailed and quantitatively backed up at this point than they were when I just kind of did a stream of consciousness for my first one that exploded.
Mm-hmm. Yeah, it's very evident how much work you've put into your posts. And of course, we're going to link to them in the show notes. So why don't we talk a little bit about some of the fundamentals of the silver market that you saw and wanted to highlight for people?
Yeah, so I guess outside of the short squeeze potential, I would say fundamentally people are desiring scarcity. In a world of unlimited money and money printing at the push of a button, they can generate more of the currency that we all hold and use every day. And people are craving things that are not subject to that power that they don't have. So I think that's why crypto has exploded. Bitcoin, like the dollar, has no actual backing or usefulness. They're both network effects, but unlike the dollar, it is limited. And the power over it is decentralized. So people feel much more confident buying Bitcoin, or some people, at least I shouldn't say people, it's still relatively underinvested for the whole population. But people are craving things like crypto, like Bitcoin, because they want scarcity. So if fiat is unlimited and unbacked, Bitcoin is unbacked, but it's limited. I think precious metals, the original universal global currency, that has lost some of its luster over the past few decades. It is naturally valuable at some level, and it is limited, at least as far as the price goes. If the price goes high enough, we will find more, but the price would have to rise to get, exponentially more into existence. So I think fundamentally, that's the sell for silver, is that It's the original cryptocurrency. It has a limit on how much there is. Some cryptos have a burn function. So as they're used, they're destroyed to limit the supply even more, to incentivize people to hold them, simply because further scarcity, the theory is that the price will go up more. Silver has, in my view, a relatively high burn function through its industrial use. Over half of the production at this point is being used for industrial purposes, and that silver stays in the products for their useful life and then end up in a dump somewhere. And while there is some level of recycling, it's been steady for decades. And that silver really just stays in the dump. It doesn't come back. And also there's silver that gets lost, just like Bitcoin, over the centuries. So it's got a burn function. It's limited. It's scarce. It's universal. People all over the world will accept silver as value. So I just see it as kind of the most superior anti-fiat play at the moment.
Excellent. So off the top of your head, and I think this is a great way to illustrate this, how much investment grade silver is there per person in the world?
Yeah. So I guess investment grade being pure fine silver. I didn't know this when I was first writing about silver. I've asked several people. No one actually knows, for one, because it's been mined for thousands of years. But there is a better hold over the 1,000-ounce bar market in terms of people trying to estimate how much of that there is. And I think the relative consensus would be around 2 million 1,000-ounce bars. So about 2 billion ounces in the 1,000-ounce investment grade form. And then the coins and small bars, those estimates vary much more widely. I've seen as low as 1 billion and as high as 4 or 5 billion. I would say maybe a median would be 2.5 billion. So if you combine the two, there's maybe 4.5 billion of investment grade silver ounces in the world. And the ones that determine the price and what I would consider kind of the total float of silver, as far as the silver market is concerned, is just the 1,000-ounce bars, because all of the other silver in the world is priced off of those. So in terms of the actual silver market, in terms of, if you're thinking of this in terms of like an equity play, the float, the shares outstanding are the 1,000-ounce bars.
So what ended up becoming the goal that you have in mind with doing all this research? How could the naked short covering cause this short squeeze?
Yeah, so I guess my goal is to make money personally. I would like my silver investments to rise in value. Disclosure, I am long silver. I don't know if you could tell that by my raving pro silver posts. But in terms of a goal for the whole movement of the silver squeeze, I would say it's for true price discovery in the silver market. Silver is a commodity. It's a real thing. And I think people would like the sellers of that thing to actually have it, and before they are allowed to sell it. So a fully backed market for silver, where people who are buying and selling actually have it and are actually willing to take delivery and have the intention of taking delivery, would be kind of the ideal endpoint. Essentially, the physical silver market would become the actual silver market.
So if you think about it like a stock, how big is the short interest in the futures market?
Yeah. So, if I described the 1,000-ounce bars as kind of the total shares outstanding, if we're thinking in equity terms, the float, or the portion that I would say is able to be delivered, in my eyes, and if you're looking at the COMEX, is the registered inventories, which is much smaller than 2 billion ounces. It's about 127 million ounces. So I would describe that as kind of the true float. And then the short interest, I tend to look at the next few months. You could look at the entire year's worth of open interest, but essentially the potential obligations for delivering silver versus the amount that's readily available to deliver. So on an equity, you have an active float of shares. And then if there's more short interest than there is the active float, then those shorts, if they're forced to buy, would have to purchase more shares than are actively available to trade. So it would actually have to cycle through several times. It causes the price to rise. That's what we saw in GameStop and other short squeezes. So May, for example, I think has around 500 million ounces. I probably should be referencing my own post here. That's actually higher, around 650 million ounces of open interest versus 127 million ounces in the registered category that are available to be delivered if they're needed. So if a large percentage of the longs in the silver market demanded delivery as they're legally obligated or legally allowed to, and then the shorts would be legally obligated to participate in, then there would be a massive short squeeze because there's not enough silver. So those shorts would have to keep offering higher and higher prices to the longs to close out their contracts because the longs have to agree to sell their futures contract in lieu of taking delivery of the silver itself. And if the price got so high or got out of control that the CME decided to cash settle everyone, essentially just, I guess no one knows exactly how this would work, but in my mind, they freeze the price at some point and just settle all contracts at their current value, flush out the system. I mean, that would essentially be a default. People entered into those contracts with the right to take delivery of silver, and they would not be getting silver. And at that point, the price, I think, would be determined outside of the exchange itself. The exchange could maybe relaunch with a fully backed system where to enter into a short position, you have to prove that you have silver ready to be delivered that's tied to that specific contract. But it would be the end of the exchange, the futures market for silver as we know it today.
So as we're talking about the futures market, we're talking about 1,000-ounce bars. So can you tell us the difference between, let's say, buying coins and small denomination bars versus buying either 1,000-ounce bars or, as you've, I guess, evolved into, buying the PSLV?
Yeah, so I came up with a pretty decent metaphor for this the other day that I posted on Twitter where I compared it to cattle futures. So if you're buying a hamburger from McDonald's or Wendy's, it has beef in it. That hamburger is technically beef, and a cow is a source of beef, but it's not the same product. And if you're talking about the price of cattle, you're not putting a direct bid under the price of cattle by buying a hamburger. You are increasing demand for an end product of that cow, which is a hamburger. And just the corollary in the silver market is a coin is an end product of a 1,000-ounce bar that has been refined. But purchasing a coin has a lot of other embedded costs. It has a premium in it that is partially determined by the scarcity and demand of the particular coin or bar that you're buying. But if you're a bank who's massively short silver and you see a lot of retail buyers, or as Wall Street Silver members like to call themselves, apes, and I say that in a nice way because we like to be called that on Reddit. I don't know. You guys can do a separate analysis on that. But if they are purchasing hamburgers, the cattle farmer, the guy who's short cattle, isn't necessarily immediately afraid that his short cattle position is going to get destroyed. And I think it's the same way with silver. If they see a rush of people buying coins and bars, they're not afraid that they're going to get squeezed out of their short position because that's not actually the same market. It's the same substance, but it's not the same market. And that hamburger comes with a bun, comes with tomato and lettuce and cheese or whatever else people put on there. There's extra costs associated with taking that portion of beef off the market. As awesome as it is to hold in your hand and to feel it or to taste it in this instance, just like a coin, it's shiny. People like to hold it themselves. It has to go through a supply chain. So, in my example, I said all the various fast food places are ordering from the same nasty freeze-dried beef factory, and they can only process so many cattle at a time into this beef that people are buying as an end product. So if people are buying up so many hamburgers that Burger King or McDonald's runs out of hamburgers, they'll place more orders with the factory for more beef because they want to sell more hamburgers. They're even able to raise their prices for those hamburgers for the same amount of beef that's being sold. But it's not actually going to end up producing much of a squeeze on the beginning market, which is the cattle market, because there's a limitation on how many cattle can be processed through that factory. And that's the exact same thing that happens with mints. So mints take the 1,000-ounce bars, they process them, and it takes time and energy and labor into these smaller end products that consumers want. And the amount of 1,000-ounce bars they can take off the market is limited at their production capacity. And I get a lot of responses saying, well, they'll just increase the capacity. I mean, that's a lot of machinery. That's a lot of investment that they have to make for what could be, and there as a temporary phenomenon of people squeezing silver. So they're not just going to build another factory because people decided that tomorrow is the silver raid day or the hamburger raid day. They're just going to do things like raise the price on the end product and push out delivery times. And that's what we're seeing in the silver market. So yes, to some extent, they can increase the amount that's coming through. And that does put some pressure on the original 1,000-ounce bar market. But if you're talking about squeezing the silver price itself, if people want their coins to become more valuable, then they need to be purchasing 1,000-ounce bars, which they can do through a few retailers. I wouldn't do it for premiums above, say, 5%. Because there are people out there that will give it to you for 5% premium. And a lot of dealers are asking more like 10 or 12% even on 1,000-ounce bars. So if you really want physical, you can buy 1,000-ounce bars, just don't get ripped off. You can also, the best way would just be to get it at the actual futures price. You could take delivery on the futures market. That's a very involved process that most people don't have access to. But I advocate what is currently, in my view, the easiest way to purchase 1,000-ounce bars and at the lowest premium, which is purchasing the Sprott Silver Trust or PSLV.
Because every share basically goes into a pool and then they back that by 1,000-ounce bars, right?
Yeah. So each unit of the trust is worth 0.36 ounces, and they only buy 1,000-ounce good delivery bars, the actual product that the silver market is based on. So purchasing more of those, putting them into the trust, increases the scarcity of those 1,000-ounce bars in the open market. And it can even bid them into a premium over what's offered on the futures exchange. If they're purchasing so many 1,000-ounce bars, they and others, that the sellers on the exchange would rather, deliver some of the inventory they have on hand than go outside of the exchange to source silver because it's trading at a premium, then they'll start delivering what's on the exchange. And that's what we've started to see right now. So PSLV and others purchasing 1,000-ounce bars has pushed the actual market price, the free, I would say, physical trade of 1,000-ounce bars into a slight premium, which is having an effect on the inventories of the CME or the COMEX.
So one of your first posts in Wall Street Bets, you talked about buying SLV shares. Can you tell us about the evolution and your change in thinking of why you now advocate for PSLV?
Yeah, so SLV, I, at the time had not done a ton of research into that ETF and did not necessarily believe the people who thought that it doesn't have the silver it claims to have. I still actually think it has the silver it claims to have. What made me really skeptical was when they changed their prospectus, which the change was dated February 3rd. I think they uploaded it February 8th. I forget exactly who broke this story. I should give them credit. But that made me dig deeper into it. And in that prospectus change, they said that in the near future, essentially if demand continues as it had, that they might not be able to find additional silver, or the authorized participants who get the silver for them might not be able to find additional silver, which doesn't make sense to me because at the time they had, 600 million ounces. And as I was saying, there's roughly 2 billion in the world of 1,000-ounce bars. So there's obviously more silver to purchase. They just would have to pay an ever increasing price if they were bidding up the price. So to me, what that read was they have a either self-imposed limit or the authorized participants are imposing a limit or telling them that they are not willing to go out and purchase silver at ever increasing prices. They are going to cap their bid that they're placing into the silver market. So a short squeeze on silver all of a sudden was not possible through SLV if they're not willing to take the inflows that they receive from investors and purchase more silver with those inflows. They're just going to be eventually holding silver in cash, or they're going to shut down share creation and their shares will trade at a premium or discount. But to me, that warranted further investigation. It also proved that they would not be a vehicle for people to participate in the real market of 1,000-ounce bars, because the price should be determined by the demand. And if demand keeps increasing, the bid price should go up. And they also had what I would call a somewhat snarky line in there about how the silver price may become disconnected from industrial demand and demand for jewelry, things like that. Did not mention at all the monetary demand for silver, which is a huge part of the demand for silver. It's the reason people buy smaller coins and bars. They're not buying it as jewelry or for use in electronics or solar panels. They're buying it as a store of value, as a monetary play. And that's what has been increasing in demand. So, in their mind, the way that read to me was they think it's ridiculous for silver to even have a monetary demand behind it. Mm-hmm. So I did not think their interests were aligned with silver investors. People started talking about PSLV. I looked into the origins of that. It's from Eric Sprott, a precious metals investor, billionaire, who has a stake in basically like every silver mine in the world. And I think his interests are aligned with the investors of silver. People are not going to invest in silver if they didn't think the price was going to go up. And the fact that SLV and SIVR are amending their prospectuses to warn their investors that the price may go up. So be ready, investors, if the price goes up, because I know that's something holders of SLV and SIVR are very concerned about if the value of their investment increases too quickly. So PSLV, it's constantly purchasing silver. Anytime the shares trade at a premium, they are taking silver bars off the market and, in my view, contributing to the potential for a short squeeze.
So as you were speaking about real supply and demand, how does JP Morgan ensure that ETF inflows never actually impact the true open market price of silver?
Yeah, so that was a conclusion that I came to after doing some research, and it is a hypothesis. I can't say I have directly seen the trading data from JP Morgan or anything like that. I have seen correlation and the SLV prospectus change, and I'm putting information together and reaching a hypothesis that I think is reasonably evidenced by the information I presented. And for one, as an authorized participant and the custodian of SLV, I guess they basically told SLV they're not willing to purchase more silver beyond a point. Another series of comments users have been giving me was that JP Morgan is actually very long silver, that they have amassed a large amount of silver. So how does that fit into the narrative of banks are short silver or JP Morgan is short silver? Well, and again, I'm hypothesizing, but maybe they have all of that silver in the custodial vaults for these ETFs. So yes, JP Morgan acquired all of this silver, this 600 million or 700 million ounce pile of silver, but it could be actually owned by the owners of the ETF. And then one thing I noticed was just comparing inflows and outflows to the SLV ETF with the price of silver. I noticed kind of an inverse correlation. And the price of silver is determined by the participants in the futures market, of which JP Morgan is a large participant, and so are other banks. And I basically then took the CFTC bank participation report and looked at the short interest of banks participating in the futures market. So this is more than just JP Morgan, but also SLV has sub-custodians that are more than just JP Morgan. And essentially there was almost like a perfect correlation, not perfect, but highly correlated relationship between inflows to SLV correlating with increased short interest from banks. So essentially, as inflows to SLV occur, short interest rises on the futures exchange. And if JP Morgan has accumulated a 700 million ounce pile of silver in various vaults. That's totally separate from the actual futures short and long position that determines the price. So, when outflows are occurring from SLV, JP Morgan has more of that silver allocated to their own account. It's not allocated to the SLV account. People were wondering how in 3 days JP Morgan or SLV acquired 110 million ounces of silver in early February overnight. That seems almost physically impossible for that to occur. But in my mind, that silver is already sitting in the vault, and JP Morgan just switches whether the name on the bar, whether it belongs to them or it belongs to SLV. So we nearly reached the limit, maybe reached it. We don't know what actually happened of how much silver was in that vault in early February. But getting back to the question, they'll switch the name over to SLV. They sell the silver to SLV. Then they go to the futures market where very little silver relative to the futures volume actually changes hands, volume and open interest, and they'll short silver to get the price down. The new wave of investors that just purchased SLV hoping the price rises, and they should be concerned based on the latest prospectus change. They wouldn't want the price to rise too quickly, but they essentially get discouraged. They sell out of SLV. SLV has outflows. So JP Morgan, the authorized participant, is repurchasing this silver at lower prices than what they just sold it to SLV. And I am hypothesizing that it's essentially just a big ATM for JP Morgan and the other banks participating in these ETFs that are not the PSLV trust that's going out and sourcing silver and shipping it to their vault in the open market. It's basically just a continuous scalp trade to take, over time, billions of dollars from retail investors, because the retail investors, they aren't going long silver. They're going long SLV, and the price of silver is determined separately on the futures exchange. And PSLV technically is not long futures either, but it is acquiring 1,000-ounce bars out of the market, which puts pressure. It puts a premium into the 1,000-ounce bar market, which incentivizes delivery. Because if people can take delivery and then sell those bars at a premium immediately, because that market has been bid into a premium, then they'll do it. And that's what we're seeing. Deliveries are going parabolic. They have been over the past year. They're continuing to do so because there's real demand for silver that's coming into contact with some fairly large, I would say, paper short positions.
Mm-hmm. So as we're speaking about, let's say, short interests, is the PSLV now hard to go short against? And if so, how do we know this?
So, I'm on a few different brokerages. I noticed on my Webull account, which is not one I have a lot of money on, but it's fun because you can do referrals and get free stocks, little things like that tiny investors like myself would care about. I noticed it did say hard to borrow. That probably just means that Webull has very little to loan out. For a time, I think, Jim Forsyth, I would say, is the PSLV expert that I would look to. You can find him on Twitter. Shout out to Jim. He thought short interest was rising as well in PSLV, but it was actually just kind of a glitch in the system where as they were purchasing new silver, they issue more shares to the new investors, essentially. And that was making it look like it was becoming heavily shorted, when in reality, short interest is closer to just like 1 or 2%. So no, I don't think at this time PSLV itself is heavily shorted, but I do think the futures market where the price is determined is heavily shorted.
Mm-hmm. So what are some metrics that we can look at to see how the silver squeeze is doing? Is it succeeding despite price continuing to fall?
I would say it is succeeding. The other two short squeezes in silver that I know of were the Hunt brothers in the 70s and into early 1980, and then Warren Buffett in 1998. And both of those squeezes were caused by the Hunt brothers and then Warren Buffett actually taking delivery on their futures contracts, as they're allowed to do. And then the inventory of readily available silver declining rapidly to the extent that shorts had to begin to cover. So if I'm looking at the situation right now, I'm seeing deliveries rising massively. And as of February, the inventories on the COMEX have started to decline. And normally what you would see is deliveries occurring every month, but those inventories not really moving. And I think that's because the silver's typically stores outside of those inventories. I think those inventories are pretty much the supply of last resort, taking silver out of the warehouse, from the COMEX is actually kind of a pain in the ass. I think people would much rather source it from outside of the futures market. So if they're having to take it from the futures market, or there's such a premium outside of the futures market that longs are incentivized to take delivery of that stock, I would say that's how the other two short squeezes began. And so, yes, I would say there's evidence that the short squeeze has begun, but that shorts are not yet forced to cover by any means. We need to see continued high deliveries, continued premium of 1,000-ounce bars above the price determined at any given time in the futures market. And you do that by buying PSLV, for example, for the short squeeze to continue. And then at some point, it's basically water building behind the dam. And the big banks, the shorts, are the dam operators. And they're trying to control the flow as best they can. They're trying to disincentivize more water coming in behind that dam to a point where the dam breaks and they lose complete control. And silver essentially has an uncontrolled rise, as was occurring in the Hunt Brothers short squeeze before the government intervened and forced the Hunt Brothers to sell out of their position. They actually forced them to sell because silver was kind of pulling a GameStop and having an infinity squeeze. And so, yeah, I think water needs to keep building behind the dam. And in the meantime, the dam operators are going to do whatever they can, whether it's depressing price while they still can to disincentivize future investment, or other shady things around their, if they have relationships with the media, or you could go as conspiracy theorists as you want. And I would say this market, compared to the traditional plays I've been involved with on Wall Street bets, has, there's a surplus of conspiracy theorists in gold and silver. There's definitely no shortage of them. But I will say the banks play dirty. I think there is evidence for that, if not definitive proof that they play dirty. There is some definitive proof. The Department of Justice called JP Morgan a criminal enterprise when they finally investigated the trading practices. And I think there were transcripts between the metals desk of JP Morgan and other banks of them basically agreeing on various slam downs of the silver price at different times. So, they are large enough. They have unlimited liquidity, unlike the longs. They can control the price of silver, essentially, until the dam breaks and it's completely uncontrollable. So, yes, there is definitive proof in that the Department of Justice investigation discovered that JP Morgan's metal desk was corrupt to the point that they called them a criminal enterprise, fined them $1 billion, which is extremely high for a financial fine. Typically these things end up finding a couple $1 million, $10 million, and it's nowhere close to the amount of money that was made through nefarious means. So if they got fined $1 billion, I can only imagine how much money they actually made if that's the time infraction and their cost of doing business fine. And also just the wording of calling a bank that is essentially fully backed as too big to fail by the US government a criminal enterprise. And I guess I'm a little ADD, so I'm going to jump around, but the fact that they are the custodian for almost every silver ETF in the world, a criminal enterprise for manipulating silver markets is the custodian of the silver for these various ETFs, is enough on its own. I think that people should immediately dump them if they are interested in protecting their silver investments.
So as you were talking about these past short squeezes in the silver market, something that you go to in your research basically names two different types of bull markets silver can experience. So which one or both are we about to see?
Yeah, so I think we'll get there, but I was looking at kind of an indicator I made up called smoke, and we'll get to that, I think, in a little bit. But I was looking at the two kind of big bull markets in silver, the 71 to 1980 bull market and the 2001 to 2011 bull market. And prior to that, silver, to my knowledge, always had kind of like a fixed price and wasn't freely traded. So there's not as much data available as I would like. You can't look at silver over 200 years, freely trading, because it actually, you go back far enough, it really was money. It was part of the monetary system. But the two bull markets, 1970s, I believe, started with the inflation impulse. People were worried about inflation and are buying silver to essentially hedge themselves against inflation worries. And silver was an attractive investment given its valuation at the time, but then was furthered along by the Hunt brothers coming in and performing a short squeeze or orchestrating a short squeeze in the silver market by just taking delivery. So that was kind of a combination of the two. But then in the 2001 to 2011 bull market, you actually see deliveries really going down throughout that entire bull market. There's not really any evidence for a short squeeze and that one having occurred. So to me, that is just more of a fundamentals based, silver was underinvested in for so long that it started to look attractive relative to the growth in the monetary supply and inflation starting to tick up in the early 2000s, the front half of the early 2000s. I think people wanted a store of value and saw silver as both a store of value and a value play. Obviously, gold comes into this very highly correlated. A lot of what I'm saying for silver could also apply to gold, including what I've said about SLV. Should probably, in my opinion, I would dump GLD and buy Fizz from Sprott, PHYS. I just like silver more because, like I said, if I'm comparing it to the other scarcity assets that people are interested in right now, crypto, it has a much higher, what I would call burn rate than gold. So much higher percentage of silver is used in industry. So the network effect value of it, the value that people place on it as a monetary system or a monetary hedge, is a smaller component relative to gold. Gold's value is highly built upon its monetary perceived value versus its industrial demand. So I think if people start to view silver as the scarcity asset that it is, it has much less capacity to absorb that demand than gold, and its price will rise more dramatically than gold. But what I'm saying fundamentally could apply to both. I just think silver is the more attractive at this time. And I don't even remember the question at this point, but I hope I answered it.
The question was, what two types of bull markets can silver experience?
Okay. Yeah. No. Okay. Yeah. I answered it.
Totally.
We're good.
So you mentioned the smoke indicator, and that's something that you came up with. What is it and what does it include?
Yeah. I mean, the information included in it is public information. It's widely available. I'm not going to pretend I'm some sort of genius for looking at it this way. I just hadn't seen it before. So I took the liberty of naming it smoke. And that's essentially the price of silver divided by the ratio of money to GDP. So if you're looking at the money supply, which a lot of gold and silver bugs like to look at, they like to point to the money supply and say, look at how fast it's increasing. There has to be inflation. People should definitely go buy gold and silver right now because look at this straight up line that is formed in the money supply. There's more money chasing after fewer goods. So, that could be true. But if the economy is growing alongside the increase in the money supply, then it's not necessarily more money chasing after fewer goods. And it also, you can get more complex and look at velocity and where that money's going, whether it can chase after other goods. But I think there's a lot of controversy around the inflation measure. People argue about it a lot, whether it's accurate. And I think velocity is more esoteric as well. But I think two elements of the GDP equation that people generally agree on is, M and Q. And I guess Q would be more real GDP. But essentially, I wanted to take two transparent things that people don't really take issue with. So money supply and nominal GDP. Real GDP would have that inflation component in it. So if you disagree with inflation, you're going to disagree with real GDP. So I took nominal GDP, I took money supply. I hypothesized that in times that the money supply is growing faster than the economy, you would maybe want to hold a scarcity asset. But in times that the economy is growing faster than the money supply, why wouldn't you rather have a cash flow producing asset like equities? Because you'll probably achieve superior returns. And there's probably not going to be as big of a demand for a scarcity asset when more goods and services are being produced relative to the rate of the money supply expansion. So I was looking at that relationship and then said, okay, silver divided by that relationship, by that ratio. Let's look at that over time. A good way for people to analyze long-term charts of any asset over which inflation has occurred and kind of distorted nominal prices is to look at a log chart. I chose natural log just because I think it's fun that silver is kind of nature's money. But anyways, I took the natural log of it, and that's the chart that you see in the DD that I posted. And it conveniently, upon me first looking at it, you could draw a natural trend line and see where the previous two bull markets that lasted 8 to 10 years each had begun. And that was the only two times it had hit that trend line. And then conveniently also, the third time that it had hit the trend line was April of 2020. So in my mind, given so far the limited history of the silver futures market, this is the beginning of the third bull market. And whether we'll get a short squeeze or not, it could be a market like 2001 to 2011 that's based on people wanting a scarcity asset, given that money supply is increasing so fast relative to nominal GDP. That could drive silver on its own. But a true, rocket ship rise for silver would come from the short squeeze, like happened in the 70s. So I think either way, we're going to get a fairly large bull market in silver in this decade. It's more of a question of how large and how fast.
Excellent. Well, I think that's a great place to leave it. Do you have anything else that you'd like to share with our audience as we wrap up?
Thank you for having me on, giving me a place to speak. Maybe I'll do more interviews in the future. But no, I appreciate the opportunity to come on. I don't think I have anything that I explicitly want to say that I haven't said somewhere else. So I think I'm good.
Excellent. Well, I think this serves as a good, let's say, audio explanation of a lot of your due diligence. Of course, we didn't even come close to covering all of it, and it's very extensive. Tell our listeners where we can find more of your research and reports there.
Yeah. So, to be continued in terms of how much I post going forward. I think I'll keep posting. It's still interesting to me. That's really what drives it. This isn't my business or anything like that. I'm a speculative, you can probably tell by my voice, I'm fairly young. I'm a speculative young investor who's currently interested in silver. And if it's a long bull market, I'll stay interested. But if you just want to follow me on Twitter, it's the Happy Hawaiian. My actual handle does not include the E in the, and that's because there's a 15 character limit. And then on Reddit, the other place that I post, I'm the Happy Hawaiian, exactly how it's spelled. So those are the only two places I'm really active on the internet. So there you go.
Excellent. Well, I really appreciate your time today.
All right. Thanks.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.